The U.S. beef industry leaders are confident long-standing Chinese restrictions on imports of U.S. beef will be lifted. China is concerned about the safety of U.S. beef since the mad cow disease broke out in 2003.
Experts are saying the increases could come as a result of the new reciprocal tariffs put in place yesterday by President Trump. So what does all of this mean for our local beef, cattle, and pork farmers? Mark Livermore.
China has just sent shockwaves through the global agricultural market by suddenly halting imports of over 150,000 tons of U.S. beef, valued at around $500 million, without any prior warning. This unexpected move came just days after the U.S. announced new tariffs targeting Chinese electric vehicles. Trade analysts believe this isn't merely a matter of food safety or import standards. Instead, it reflects the growing strategic tension between the world's two largest economies. For American exporters who rely heavily on access to the Chinese market, the decision has triggered immediate and significant financial losses. Meanwhile, global competitors have wasted no time stepping in to fill the gap. Behind the scenes, the suspension of U.S. beef imports followed low-profile inspections at Chinese ports, timed almost exactly with Washington's latest tariff escalation. While Beijing officially cited food safety concerns, many experts believe this was a calculated response meant to send a clear political message to the U.S. In 2024 alone, American beef exports to China topped $1.2 billion, making it a key market for U.S. agriculture. China's sudden and unilateral action, without negotiation or warning, underscores a broader shift in bilateral trade relations. This isn't just about one product or a few shipments. It signals how global trade can be reshaped in an instant by geopolitical decisions. Data from the U.S. Department of Agriculture shows that within just weeks, over $520 million in beef orders were either canceled or rerouted. States like Texas, Kansas, and Nebraska, major beef producers, have been hit especially hard. Ranchers in these regions are now dealing with surplus cattle and no access to export markets, which is pushing down domestic prices and increasing financial pressure across the supply chain. One Nebraska rancher told reporters that contracts arranged months in advance are now being offloaded onto the domestic market at major losses. The impact goes beyond the farms themselves. Feed suppliers, logistics companies, and cold storage providers are all feeling the disruption. Some have even had to lay off workers. While China insists the ban was about food safety, policy analysts argue it's clearly a strategic countermove to recent U.S. trade actions. Since agricultural states play a crucial role in U.S. elections, this blow to American farm exports carries serious political consequences at home. Meanwhile, Russia has quickly taken advantage of the situation. In just the first quarter of 2025, Russian beef exports to China skyrocketed by over 300% compared to the same time last year. This boom is largely thanks to a 2023 agreement that streamlined inspection processes and opened the Chinese market to more Russian processing facilities. Russia is now positioning itself not just as a temporary replacement, but as a long-term supplier. Major infrastructure projects have helped Russia rise quickly as a key meat supplier to China. A new railway line, launched in late 2024, now directly connects Russian cattle-producing regions with Western China, slashing delivery times. Payments are being settled in yuan or rubles, eliminating the need for US dollars and aligning more closely with China's financial strategies. Russian trade officials say this growth is driven not only by increased demand from China, but also by deeper cooperation and improved logistics between the two countries. With China importing nearly 25% of the beef it consumes, a market previously dominated by the US, Russia is stepping in to claim a bigger share. Moscow has announced plans to invest an additional $1.1 billion to double its beef production by 2027, with large-scale industrial farming projects already underway. While some concerns remain about food safety and logistics, China seems willing to accept these risks as long as its trade partners support its broader strategic goals. Other traditional beef suppliers are facing their own challenges. Argentina continues to struggle with inflation and unstable trade conditions, making it difficult to offer consistent pricing or supply. Australia, despite efforts to repair trade relations with China, still deals with unpredictable import inspections. These hurdles make it hard for either country to provide the long-term reliability China now demands. Russia's success isn't just about producing more beef, it's also about adapting to China's shifting trade priorities. Since early 2025, most beef contracts between the two nations have been settled in yuan, or rubles, bypassing the dollar entirely. With faster shipping via the new rail line and a long-term partnership framework in place, Russia has become China's preferred supplier. For Beijing, strategic alignment and reliability now seem more important than strict quality control or exact quantities. In March 2025, China also imposed new tariffs on over 700 U.S. agricultural products, including pork, dairy, almonds, and sorghum, affecting more than $11 billion in trade. This move came right after the U.S. reintroduced tariffs on Chinese tech exports. Analysts say this back and forth isn't just short-term retaliation. It marks a deeper trend toward trade decoupling, where agriculture is increasingly being used as leverage in broader geopolitical negotiations rather than treated as a neutral economic sector. The numbers speak volumes. In 2022, the US accounted for more than 12% of China's beef imports. By early 2025, that figure had fallen below 6%. With no clear path to improved diplomatic relations, American exporters are at serious risk of being permanently edged out of one of the world's fastest-growing meat markets. As China strengthens its trade networks with partners that share its strategic vision, the window for former suppliers to return is closing. Meanwhile, Washington is preparing another round of tariffs on Chinese goods, this time worth approximately $18 billion, fueling even more concern about escalating trade tensions. Recent data shows that U.S. agricultural exports to China have already dropped nearly 28% this year. Economists warn that ongoing tariff battles don't actually protect domestic markets in the long run. Instead, they tend to shrink global trade overall, harming both sellers and buyers across the supply chain. While tensions with Washington continue, Beijing has been actively forging long-term food supply agreements with Russia and other partners, most of whom have moved away from using the US dollar entirely. This isn't just about tariffs or isolated trade disputes. It's part of a much deeper transformation in how global supply chains are structured. China is increasingly partnering with countries that align with its political outlook, offer stable logistics, and are open to flexible, local currency payment systems. If the US doesn't rethink its approach, the consequences could go beyond losing market share. It could mean being left out of Asia's agricultural growth altogether. Many experts argue that Washington needs to shift from short-term retaliatory measures to a more strategic, long-term plan. What's unfolding isn't just a trade dispute, it's a sign of shifting global power. As China reconfigures its supply chains, especially for critical goods like food, the impact reaches far beyond any single country. These changes are reshaping regional alliances and undermining long-standing trade relationships. By strengthening ties with countries like Russia and Kazakhstan, China is building a food security network that combines economic interests with diplomatic goals. And the ripple effects go far beyond beef. Trade analysts are closely tracking these developments, warning that the long-term consequences could be profound. Deborah Elms of the Asian Trade Center noted that once logistics infrastructure, payment systems, and regulatory standards are firmly integrated with new partners, it becomes extremely difficult for former suppliers to return. This isn't just a matter of mending diplomatic ties. It would require rebuilding a complex trade ecosystem from the ground up. That's why many believe the US is not just temporarily shut out, but potentially facing exclusion from key agricultural markets for years to come. Meanwhile, China is also ramping up domestic production. In 2024, its beef output rose by more than 5%, supported by state investments in regions like Inner Mongolia and Sichuan. It's clear that Beijing is pursuing a two-pronged strategy, forging deeper international partnerships aligned with its political and economic priorities, while also boosting self-sufficiency at home. For US exporters, this creates a double challenge, facing fiercer foreign competition and a Chinese market that's becoming less dependent on imports. Many of China's new long-term contracts with Russia and Kazakhstan are locked in through multi-year agreements and local currency payments. These aren't just trade deals. They're part of a deliberate strategy to reduce reliance on the US dollar and limit future US market re-entry. If these agreements hold, the US risks more than just a temporary setback. It could lose its structural foothold in one of the world's most important agricultural markets as China secures diverse, politically aligned sources of protein and other food products. The big question now is, can US agriculture adapt? For decades, American farmers and exporters depended heavily on Asia's massive buying power for beef, soybeans, pork, and dairy. But with global financial systems evolving and new trade alliances strengthening, US producers may need to rethink their strategies, either by finding new markets or aligning with the emerging trade and currency frameworks. Failing to adapt could mean a long-term decline in America's role in global food trade. While many in the agricultural sector hope for a diplomatic breakthrough, the current trends suggest that a deeper restructuring is already underway. With the tariff battle escalating and other nations signing long-term deals, simply waiting for the situation to resolve may no longer be a viable strategy. What's needed is a more proactive approach, expanding into new markets outside Asia, improving trade relationships, and engaging more seriously with emerging global financial systems. China's actions aren't purely about economics anymore. Food trade has become a tool for diplomacy and geopolitical influence. By strategically managing imports, China can reward friendly nations and sideline those it sees as adversarial, without firing a single shot. This is a form of soft power. And while it comes with its own risks, it's reshaping how global trade works. For observers and policymakers alike, the key is to look beyond tariffs and statistics, to understand the broader consequences. Trade disruptions have real-world impacts on jobs, food prices, and the economic health of rural communities around the world. As politics increasingly shapes global food supply chains, long-term stability will depend on trust, cooperation, and adaptability between trading partners. Without these foundations, even long-standing trade relationships can break down overnight. What we're seeing in US-China agricultural trade is just one example of a much larger trend toward global economic decoupling. From semiconductors to soybeans, the world's two largest economies are redefining how they interact in trade. Policies that once seemed isolated are now aligning into a broader shift, where supply chains are reorganized around strategic alliances rather than just price and efficiency. For American agriculture, this means success will no longer depend solely on product quality or competitive pricing. It will also hinge on diplomacy and the ability to adapt to a changing global order. As new trade routes are built and agreements signed, it's becoming clear that agricultural trade is entering a new era. China's pivot toward Russia and other politically aligned partners shows that trade today is about far more than goods and services. It's about power, influence, and resilience. Countries are preparing for a future where supply chain shocks are common, and stability comes from diversification, investment in infrastructure, and reduced dependence on any one currency, especially the US dollar. In today's fast-changing global landscape, adaptability is no longer optional, it's essential. Looking ahead, we can expect to see growing investments in domestic food production across Asia, more long-term supply contracts that sideline Western exporters, and a continued shift away from US dollar-based agricultural trade. These changes won't happen overnight, but the groundwork is already being laid. Countries are planning for the long term, often decades ahead. If American exporters want to stay competitive, they'll need to rethink their long-term strategies as well. The global trade environment is evolving quickly, but there's still time to adjust. Trade has always been a dynamic, ever-changing ecosystem. History shows that economic relationships can be reshaped even after major disruptions. For the United States, this may mean rejoining or reimagining its role in multilateral trade deals, reevaluating tariff strategies, and expanding partnerships in emerging markets like Southeast Asia, Africa, and Latin America. This new reality also calls for a serious look at how the US engages with the global financial system. Transitioning towards structures more suited to a multipolar world won't be easy, but it's necessary if the US wants to maintain influence in a rapidly shifting global economy. Infrastructure diplomacy is also becoming more important than ever. Initiatives like China's Belt and Road, Russia's expanding railway networks, and the yuan-ruble payment systems are not just about trade logistics. They're strategic tools of influence. For this reason, the US and its allies may need to increase investments, not only in domestic capabilities, but also in international systems that support transparent, stable, and secure trade flows. If the US misses this moment, it risks more than just losing market share to direct competitors. It could also fall behind due to larger structural changes in the way global trade operates. For consumers, these changes will inevitably affect food prices and access. As supply chains shift and new settlement currencies take hold, costs will fluctuate and availability will vary from region to region. Food, which once moved freely across borders, is increasingly passing through political filters. Understanding this new environment is crucial, not just for policymakers and trade professionals, but for everyday citizens as well. Trade isn't just about goods and numbers, it's about trust, cooperation, and long-term vision. Whether you're a farmer, a decision maker, or someone doing their weekly shopping, staying aware of global trends has become more important than ever. The rise of new trading partners, the withdrawal of traditional players, and the redrawing of the global agricultural map all point to one thing. The future of trade belongs to those who are agile and ready to adapt. Today's disruptions don't happen in isolation. They reflect a complex mix of factors: political transitions, energy policies, financial shifts, and climate change. One extreme weather event, a supply chain bottleneck, or a disease outbreak can accelerate trends that were already in motion due to tariffs and geopolitical tensions. In other words, we're living in a time where trade is more unpredictable than ever before, and that uncertainty can be just as damaging as any policy decision. Behind every trade statistic are real people: farmers, food processors, truck drivers, port workers, whose livelihoods rely on a stable, functioning trade system. A single government decision or diplomatic fallout can suddenly put thousands of jobs at risk, something that doesn't always make the headlines but has lasting consequences on the ground. At the same time, these challenges also present new opportunities. As global trade relationships shift, emerging markets, smaller producers, and regional alliances that once seemed unlikely are stepping into the spotlight. Any country or business that's willing to diversify its export destinations, invest in logistics, or adopt new payment systems stands a better chance of weathering the turbulence, and might even come out stronger. Yes, change brings risk, but it also creates space for innovation and growth. Whether you're a rancher in the US, a shipping manager in Southeast Asia, or an investor in Europe, these developments will shape your reality, from food prices and job markets to currency values and supply chain access. That's why it's important to look beyond the headlines and understand the bigger picture. We're not just talking about beef exports, we're talking about a complete reconfiguration of the global food trade system. In early March, China responded to US trade policies with new retaliatory tariffs hitting roughly $21 billion worth of American agricultural goods, including pork, dairy, sorghum, almonds, and poultry. Beijing imposed tariffs of 10 to 15%, officially citing US trade measures dating back to the Trump administration. But many experts argue this is about more than retaliation. It's part of a long-term strategy aimed at putting political pressure directly on US farm states, which are key battlegrounds in American elections. The most immediate impact was the expiration of export licenses for hundreds of US beef processing plants under the Phase 1 trade deal. By mid-March, Chinese customs authorities had let these licenses lapse without renewal. As a result, beef exports to China slowed to almost zero by early April. With no indication of when, or if, those permits might be reinstated, US meat exporters now face deep uncertainty. This affects not only current shipments, but also their ability to negotiate new contracts. At the same time, China has launched a comprehensive review of its beef imports, citing concerns over domestic oversupply. This audit, covering data from 2019 onward, includes major suppliers such as Argentina, Australia, Brazil, Uruguay, and the United States. The results, expected by the end of the year, could lead to tighter import restrictions and have far-reaching consequences for global pricing and availability, not just for US producers, but for their competitors as well. Meanwhile, China is accelerating imports of other grains and crops. It has sharply increased purchases of Russian peas and wheat as part of its deepening trade ties with Moscow. In fact, this year, Russia overtook the US as China's top exporter of spring wheat. And if China lifts its current ban on winter wheat, Russia could tighten its hold on that market even further. This evolving trade landscape highlights China's strategic pivot towards sourcing key agricultural staples from politically aligned partners. At the same time, Russia is capitalizing on previously seized Western assets, such as the canned food brand Glav product, to expand its exports to China, North Korea, and other emerging markets. While this shift hasn't yet upended global markets, it marks a significant transformation. Russia's agricultural sector is moving from a focus on self-sufficiency toward becoming a critical, export-oriented supplier, increasingly tethered to Beijing. All of this points to a broader reality. Geopolitics is now deeply shaping business decisions and the flow of goods across regions. These developments are unfolding amid tightening economic ties between China and Russia. Their cooperation extends well beyond simple trade deals. It includes local currency payment systems, ruble yuan, cross-border logistics infrastructure, and long-term strategic agreements. Experts describe this as a deliberate alignment that has taken years to build, with one shared goal: resisting Western sanctions. This isn't a fragile or temporary partnership. It's an institutional framework that is steadily growing stronger. The surge in bilateral agricultural trade is also drawing global attention. Even major players like Brazil and Argentina, longtime leaders in soybean, beef, and grain exports, are strengthening their own relationships with China. Meanwhile, producers in Europe, Canada, and across the Pacific are stepping in to fill the gap left by the United States. What's emerging is a more diversified, multi-currency food trade system that is gradually eroding America's once dominant position in the global agricultural market. For US exporters, returning to the Chinese market will require far more than resuming tariff negotiations. The rules of the game have changed. Export eligibility is now tied to legal and political reliability. Payments are increasingly made outside the US dollar. Logistics are being streamlined through China's Belt and Road Network, and long-term contracts are being embedded within broader geopolitical alliances. To regain lost ground, the United States will need to rethink its entire trade strategy across legal, financial, and diplomatic dimensions. China, meanwhile, continues to apply pressure. In March, Beijing imposed tariffs of 10% to 15% on a wide range of American agricultural goods, valued at over $21 billion, including pork, dairy, almonds, sorghum, and poultry. Analysts say this wasn't just a tit-for-tat response to US policies. It was a targeted political maneuver aimed at hitting key American farm states that hold major sway in US elections. Compounding the issue, China allowed hundreds of export licenses for US beef processors to expire in mid-March, bringing shipments to a near halt by early April. With no timeline for renewal, American companies are left in limbo, unable to secure new contracts and facing major disruptions to their supply chains. Adding further uncertainty, China has launched a comprehensive review of global beef imports going back to 2019. If this review concludes that imports are harming domestic production, China could implement additional tariffs or import quotas. The investigation includes all major suppliers: Brazil, Argentina, Australia, and the US, and is expected to wrap up by mid-2025. This means the export window could shrink even more, not just for American suppliers, but for global competitors as well. China-Russia agricultural cooperation is also extending well beyond beef. China has significantly ramped up imports of peas and wheat from Russia, making Moscow its largest supplier of yellow peas. Analysts believe this trend could soon extend to spring and even winter wheat should China lift its current ban, further cementing Russia's role as a go-to source for staple foods. At the same time, Russia is making strategic use of confiscated Western assets, like the Glav product brand, to boost exports to both China and North Korea. It's part of a broader effort to reorient its economy around exports, powered by strategic partnerships rather than domestic demand alone. The level of economic integration between China and Russia is accelerating fast. In 2024, their bilateral trade reached roughly $245 billion, with more than 95% of those transactions conducted in rubles or yuan, effectively removing the US dollar from the equation. New cooperation agreements in agriculture, tech, and finance suggest that this is becoming a deeply systemic relationship, with shared infrastructure, supply chains, and long-term investment flows. But the influence of this shift isn't limited to just China and Russia. Across South America, countries like Brazil, Argentina, and Uruguay have adjusted their exports to match China's new policies. At the same time, suppliers from Europe, Canada, and the Pacific are breaking into new markets and exploring alternative payment systems that bypass the US dollar. The result is a multi-layered global food supply network that is steadily moving away from the US-centric trade order of the past. For American exporters, the challenge is no longer just about lowering tariffs. They now face an entirely new trade environment, one that requires plant recertification, adoption of ruble-yuan transactions, and logistical integration into China's rapidly expanding trade routes. To make matters more complex, politics is now directly embedded in trade contracts. In March 2025, China imposed fresh tariffs of 10% to 15% on more than 700 US agricultural products, including soybeans, corn, wheat, pork, and beef, collectively worth around $21 billion. While these measures were officially framed as a response to US tariffs and national security concerns, many analysts argue they were strategically designed to strike at politically sensitive farming regions in the US. China's current trade model makes it clear non-tariff barriers, currency swaps, and diplomatic alignment are no longer side issues. They're now central features of international commerce.